Parag Parikh says, best time to buy equities when you don't feel like buying. This is the exact time where you can accumulate quality stocks at discount. Nifty has given hardly any returns in last 16 months. Small cap index is inching up, but not our portfolio. In the next few minutes, I'll show you 5 hidden gems which are reasonably valued and trading at discounted price from their all-time high. Fifth company is my personal favorite, so stick to the video till the end. These are not hype stocks and not penny picks either. These are real businesses with cash in the bank, strong order books, and long-term moats. Before starting the video, I request you to please subscribe my channel if you love such content. Like the video and comment which company is your favorite with rationale. Just a small reminder, this video is only for educational purpose. Please don't consider this as a buy or sell recommendation. To find these quality stocks, I have made thorough research and applied some basic checks. Companies with minimum to low debt to equity, efficient management with good track record and corporate governance. Company working in niche industry with huge growth in future. And last one is good sales growth, bad growth with excellent financial ratios. So let's see one by one. First company on the list is Gravita India Limited. Currently, company has 13,400 crore market cap and its share price is trading 35% discount from its all-time high. Why Gravita? Gravita India isn't your typical manufacturing company. It's an integrated recycler collecting scrap metal and waste and converting it into usable products that industries and batteries depend on. They work with lead, aluminium, plastic, and rubber, and now they're expanding into lithium ion, tire, and paper recycling. Let's talk hard numbers because that's where Gravita truly shines. In FY21, the company made 1,410 crore in revenue. By FY25, that number jumped to 3,869 crore. That's a 29% compounded annual growth. Now, profits grew even faster from 57 crore to 313 crore, an incredible 53% CAGR in just 4 years. Even with that growth, Gravita has kept its balance sheet rock solid. Debt to equity is just 0.14 and ROE and ROCE hover around 21-22%. That's high growth with strong returns, the dream combo every long-term investor looks for. Gravita is investing over 1,225 crore by FY28 to expand capacity to 7 lakh metric tons per annum. This expansion includes new recycling plants in India and Europe, including a 17,000-ton tire and rubber plant in Romania. Free cash flow turned negative last year, but that's because the company is reinvesting aggressively into new capacity and acquisitions. India's recycling industry is already worth billions of dollars and still massively underpenetrated. With stricter government policies on waste and battery recycling, Gravita sits right at the center of this green revolution. Management has excellent execution track record, they have proven it. They've maintained consistent dividends, AAA credit rating, and strong profitability despite volatile commodity cycles. Promoter holding has come down a bit, but on the other hand, FIIs and DIIs are increasing their stakes. Now, is it risk-free? Definitely not. It still depends on metal prices and global commodity cycles. And with heavy capex ahead, execution risk is real. One bad project can hurt returns. Second company on the list is Tarachand Infra Logistics Limited. It is trading at market cap of 600 crore. So what exactly does Tarachand Infra do? It's not just a logistics company, it's a complete infrastructure solutions provider. The company operates in 3 core verticals: infrastructure development, handling EPC and construction projects for industries, ports and power plants; logistics and material handling, managing heavy cargo, cranes and equipment for industrial and infra projects; warehousing and engineering services, offering storage, fabrication and equipment rental solutions. Now, let's talk numbers because that's what separates hype from conviction. In FY21, Tarachand's revenue stood around 110 crore. Fast forward to FY25 and it's crossed 248 crore, that's nearly a 2x jump in just 4 years. Profits have followed suit from 3 crore in FY21 to over 25 crore in FY25, marking a 40% plus CAGR in earnings. The company's return ratios are impressive too. ROE around 17%, ROCE close to 20%, showing efficient capital use and strong project execution. And despite being in a capital intensive industry, Tarachand has kept its debt to equity below 0.6, a rare feat for a growing infra firm. Now you might ask, why call it a potential multibagger? Because Tarachand is scaling in sectors that are exploding with opportunity. India's infrastructure sector is expected to touch 1.4 trillion by 2030, and logistics could grow at 8 to 10% CAGR this decade. As projects like dedicated freight corridor, smart cities, and port expansions move ahead, companies that can execute both construction and logistics like Tarachand stand to benefit big time. Recently, Tarachand announced a strategic capex plan to expand its equipment base, crane capacity, and warehousing footprint. It's also eyeing new ports and industrial zones for contracts with an order book estimated at 130 plus crore, providing next year of revenue visibility. The promoters have decades of experience in infrastructure logistics, a skin in the game ownership, and a reputation for timely execution. The company maintains transparent disclosures, pays regular dividends, and has shown tight control over working capital, all marks of solid corporate governance. Here's a quick health check for context. Revenue CAGR of 5 years is 20%. Profit CAGR for 5 years is 35 to 40%. PEG ratio is 0.17, showing undervaluation compared to growth. Free cash flow is positive in most years, reinvested for expansion. Now let's talk about next company, GG Automotive Gears Limited. It has market cap of around 269 crore. Good Game Automotive Gears designs and manufactures precision gearboxes, shafts, and pinions used in defense, mining, railways, steel, and power equipment. They cater to heavy engineering clients, companies like BEML, Indian Railways, and other PSU giants. In FY21, company's revenue was around 30 crore. By FY24, it crossed 114 crore. That's more than 2x growth in 4 years at a CAGR of over 22%. Operating profits have grown from 2 crore to over 17 crore. That's nearly 8x growth. Operating margins have improved sharply, touching around 15 to 16%, showing better cost control and product mix. What's more impressive, debt to equity is now below 0.5, meaning the balance sheet is getting cleaner every year. And the company's ROE stands around 20%, while ROE hovers near 17 to 18% solid by engineering standards. So why are analysts calling it a potential multibagger? Because it sits right in the middle of three booming sectors: defense, infrastructure, and railways. With the government's Make in India and Atmanirbhar Bharat focus, there's a massive shift toward indigenously manufactured components. That means GGAG's products, heavy-duty gear systems, and gearboxes are in more demand than ever. Over the last few years, they focused on backward integration, better working capital discipline, and consistent dividend payouts, all signs of management maturity and financial prudence. Good Game Auto still depends heavily on industrial cycles. Any slowdown in infra or defense spending could impact volumes. Also, raw material prices, especially steel, can pressure margins in the short term. Let's talk about fourth company in the list, BLS International Limited. It has a market cap of around 12,800 crore and share price is trading around 310 to 320. BLS is quietly becoming a global tech-enabled platform that runs visa, consular, and government to citizen G2C services across the world. And in the last few years, it's transformed into a high-margin, cash-rich machine that's buying growth faster than ever. BLS handles all the behind-the-scenes work when you apply for a visa, from biometric enrollments to consular services and e-governance tasks for governments. They are present in more than 70 countries, have processed over 360 million applications, and work with 46 plus governments. Now here's where it gets interesting. In just 4 years, from FY21 to FY25, BLS grew its revenue from 478 crore to 2,193 crore. That's an insane 46% CAGR. And profit from 48 crore to 606 crore, that's 85% CAGR. Return on equity 31%. ROCE around 22%. Debt levels minimal, just 359 crore of borrowings, making it effectively net cash positive. This is what capital efficient compounding looks like in action. Three smart moves changed everything. 1. They started running more visa centers themselves instead of outsourcing that boosted per application revenue. 2. They scaled up using tech and automation, improving efficiency. 3. They went global with smart acquisitions like iData for about 720 crore and Citizenship Invest for 260 crore, giving them a strong presence in Europe and the premium residency space. Here's why the runway is long. Governments across the world are outsourcing citizen services from visas to e governance to document verification. BLS, with its global footprint and multiple ISO CMMI certifications, already has the trust and eligibility that new entrants can't buy overnight. That's a huge competitive moat. The company is promoter led, with promoters holding around 70.39% stake, serious skin in the game. Governance, clean record, CRISIL A, A1, positive, credit rating, and ISO certified operations. Now, no stock is perfect. There are some risks also. Tender renewals are always a key risk. Losing a big contract can hit short term revenue. Integration of those new acquisitions will be crucial. Plus, geopolitical changes or new visa regulations can impact volumes. But the company's tech systems and global diversification do cushion these risks. BLS has quietly evolved from a steady operator into a global platform business. High margins, zero debt, and cash rich operations, that's a rare combo. If management executes the integration well and keeps winning new contracts globally, earnings could compound fast. And that's exactly how small cap stories turn into multibaggers. But as always, patience and monitoring matter. Now let's see fifth company on the list, Affle India Limited. When you open an app and see that perfectly timed ad, chances are Affle India is behind it. I know you might argue for its valuation, it's commanding high PE due to its excellent financials. Company had reported 33 quarters of continuous growth. Can you imagine the execution level of management? Let's decode why Affle India could be one of India's most underrated multi-bagger stories in the making. Affle is a consumer intelligence and digital advertising tech company. In simple words, it helps brands identify, reach, and convert smartphone users into customers. Its platform runs across mobile apps, browsers, and OTT using AI, machine learning, and deep data insights to show the right ad to the right person at the right time. Affle earns revenue when users take action, not just when ads are shown. That's called a cost per converted user (CPCU) model, a massive edge in performance marketing. And here's the kicker, this isn't just an India play. Over 60% of its revenue comes from international markets like Southeast Asia, Middle East, and Latin America. Over the last 5 years, Affle's business has scaled like a tech rocket. Revenue grew from 167 crore in FY18 to over 2,266 crore in FY25, that's 13x growth in last 8 years. Profits jumped from 28 crore to around 382 crore, growing more than 13x in the same period. Company had delivered on every front, EBITDA, PBT and PAT, while generating 426 crore of free cash flow. The company has zero long-term debt. India's digital ad market alone is projected to grow from $10 billion in 2023 to over $25 billion by 2028, a CAGR of nearly 20%. Globally, the mobile ad industry is growing at 15 to 18% CAGR, driven by AI, 5G, and data-driven personalization. The company has 36 patents across India, the US, and Singapore, including 10 granted and 26 filed and pending patents. Affle's management is one of the most consistent and transparent in the digital space. Anuj Khanna Sohum, CEO, is the visionary behind the company's data-driven ad ecosystem. The company maintains clean disclosures, timely reporting, and ESG-conscious operations. No major corporate governance red flags. Promoter holding remains above 55%, showing strong skin in the game. That's all from my side. All these 5 stocks I have discussed has potential of being multi-bagger over long term. If this video really helped you to find some gems, please like the video. Comment your favorite stock with rationale. And do subscribe my channel to get valuable content, and don't forget to hit the bell icon. Thank you.